Welcome back. I have the pleasure again to have Martin Tixier here, with whom I discuss financial markets. We have been encountering again two interesting weeks, and today we will talk about a couple of topics. One is luxury good, also about the complacency of market. Hi Martin, good
Hello.
to have you here. I see you have also a new camera, and that's great, so people can see you now in higher resolution. Much more importantly, you have written again a very interesting piece in your Substack with the
Yes.
title Crossing the Rubicon, which I like. What were you thinking about coming up with this title?
Several things. Of course, there's a historical parallel because crossing the Rubicon, it signifies passing the point of no return, which is akin to what you mentioned, Julius Caesar's fateful decision, which precipitated the fall of the Roman Republic historically. And in terms of the modern context, crossing the Rubicon means several things. First, it's the potential for a fiscal crisis in the United States, given the U.S. debt trajectory, because the United States needs to raise around $10 trillion dollars of refinancing in 2026.
That's in 1 year. That's just this year.
Exactly.
10 trillion.
Yeah, and now 19% of the revenue is spent on interest, which is unsustainable, which is echoing Jeffrey Gundlach warning, which he did a video about private credit being an unmitigated disaster. As well, you want to add gold reserves with France withdrawing their gold reserve from the New York Fed.
Mm-hmm.
And the last time they did that was 1967. Prior to the 1971 Nixon shock, which signaled a monetary system reserve risk. So there's a lot of things happening. And on top of that, crossing the Rubicon is also akin to the situation with the Strait of Hormuz, because we're very close of passing the point of no return in terms of the supply shock. The more days the Strait of Hormuz stay closed, the closer we are coming towards utter disaster in terms of supply. We're already seeing some rationing taking place in places like Pakistan, Sri Lanka. There's also Philippines, which has been heavily impacted on diesel and jet fuel. So we're already seeing the first signs of the supply shock coming into play. We also have international airlines reducing the number of flights. You had announced from SAS, Lufthansa, but the more the standoff between Iran and the United States goes on, the more the Strait of Hormuz stay close to shipping, the bigger will be the damages. And as such, recently I highlighted in my presentation as well on my Substack notes the very, very strong, tight relationship between energy and world GDP. The correlation is about 98%. So if there's supply destruction, in the current course of action, in a very, I would say, bad case scenario for 2026, I've estimated that the damage in a worst case situation could be in the region of $5 to $6 trillion, which would reduce the global world GDP by a factor of around 5 to 6%. So
which would be devastating.
Which could be devastating. Yeah. So the longer this situation goes on, the bigger the outcome, and that's why I've used crossing the Rubicon, because we're coming close to the point of no return, which could come from this supply shock. Which would be happening on a global scale.
And what is interesting is the disconnect. If I look at the sentiment now in markets, like the Nasdaq has it reached the all-time high again? And when I look at rational data, really the clear data on we have today April 21st. And I just saw this morning again the crossing via the Strait of Hormuz. It doesn't look better yet, despite the improving sentiment. And for me, what is remarkable that the market is not pricing any tail risk, like any probability out of this. For me, it seems that the generation of dip buyers who haven't experienced really a real crisis have taken over, or is it AI? I don't know, but that's quite remarkable on my side. Also, what I have seen, and I was trying to take some chips off the table, also in my global listed real estate portfolios, selling some data center exposure. But yeah. But how you see the complacency of financial markets, you with your background, with your credit?
Yeah, well, we were there was a lot of discussions about a second wave, a second inflationary wave, in a similar fashion that what we saw in the 70s, and I think that it's baked in the cake. The stagflationary outcome is there. From just a historical perspective, wars, in essence, are inflationary. As such, the stagflationary outcome is going to play out, which means it's going to be very negative for fixed income products as such. So the issue with stagflation is that it raises the cost of capital. Very simple. So we've seen we've seen a higher pressure on sovereign yields. We've seen a significant rise in sovereign yields on a global scale, except there's been one exception in market, which has been quite surprising, and people wondering if it's the new safe haven. It's been the 10-year yuan.
Mm-hmm. And Switzerland as
bond.
well. Switzerland has also
Switzerland
reacted
as well.
Quite limited.
Absolutely. So when you think about the traditional 60-40 portfolios, they are totally broken when you think about the fixed income side, because U.S. Treasuries are definitely not safe havens anymore. And as such, when people look at RMB, you see a lot of growing issuance of people issuing into Chinese currency. Why? Because they can borrow very cheap, like at 185% over 10-year. Yeah, no brainer, really.
It's interesting. Wall Street kept lecturing us now for 3 years that China is uninvestable. Nobody should have touched Alibaba, when it was 50% lower than this. Very interesting also that now also the bond markets are seeing a better bid in light of the mess and the fiscal situation in the West has created.
Absolutely. And I think we've gone to the point where you really need to play being much more defensive. That's what we mentioned in the last conversation, having like shorter duration. I think it's a must have. I think as well, you need to look at outside. You need international diversification. And on this, I fully agree with Jeffrey's good luck take about having, he even recommends 100% international equities exposure and having 40% of portfolios exposed to equities. So he doesn't even want to have exposure to United States equities when I watched the previous interview he made recently on YouTube. And I think in this environment, yes, you need international diversification for sure. You need to be much more defensive. And I think, as you mentioned, data centers that you cashed out. And I think it's realistic for two reasons. First, rising cost of capital. Stagflation will mean that capital cost will rise. So that's a headwind. As well, data centers, everyone is throwing a lot of capex, like the big 4s or 5 hyperscalers, the likes of Meta, Alphabet, all these guys, Microsoft are going to be throwing more than $600 billion in capex for 2026. Now, on paper, it's great, but realistically, is it achievable? No. Like half of the projects of data centers have been canceled. And there's a very simple reason for this. Realistically, United States cannot disconnect themselves from China, because China is still the largest provider of gas turbines as well as electric parts, which are essential for the build out of data centers. No matter amount of capital you want to put on the table, city is scarcity. And as we mentioned previously, it takes 15 years to roll out a copper mine. And there are not enough copper flying around. There's a lot of demand, there's not enough supply. So we're facing like a double, I would say, supply shock. One coming from the energy sector, which is happening before our very own eyes in the Strait of Hormuz. And the other side, we know that there is scarcity when it comes to the ambitions of the big players, the big hyperscalers, when it comes to building out data centers, because there's not enough supply flying around. Copper prices are under pressure. Silver is under pressure. It's all linked to scarcity.
Absolutely. But I want to take you somewhere else now, also into a structural topic, and scarcity is a good word for it. It's the luxury goods sector, which has always has benefited from the scarcity problem. But I remember we have talked about the Birkin Bag Bubble. Did that one now burst?
Yes, I think it has burst. We're seeing on the secondary market a very big reduction in the premium between, I would say, the primary market, which is the bag you buy at the Hermès shop, and the secondary market, where people were still very readily to pay a very hefty premium to buy a secondhand Birkin bag. And now the premium is shrinking. And it seems to me that from a long-term perspective, we're seeing a very we're seeing some very strong pressure on luxury brands, and it's coming from some kind of change in consumer patterns, which I believe are happening, in the sense that I think it's less about owning a luxury item, but it's more about the experiences. And it seems the new generations are more akin into buying experiences than buying objects. And I think that's what we've seen in throughout many years, some luxury brands branching out, reaching out in the hospitality sector. You have the Bulgari hotels. Not only Bulgari hotels, you had Ferragamo, who has created their own luxury brand of 5-star hotels. But we're seeing as well LVMH and as well as various family offices building out portfolios of luxury premium 5 stars, either boutique hotel or large hotels. And I think we're seeing a stronger trend in that direction in terms of real estate. Maybe you can confirm what I think is changing in terms of luxury consumption on your side or not.
I think you are spot on that one. So what we are seeing also in the composition of transaction volumes, that now, especially in Southern Europe, the hospitality sector has become much more important than it was previously, and that's also where people also like to spend their money. So on my side, I first thought it's really like more a catch-up effect, what we have seen from Corona, because people were inside and wanted to get out, and now were not so much, also not much price sensitive in the hotel space, which drove up the luxury rates on some hotels. Like if you're in Mediterranean, it's crazy. We also looking at some of the investments in the hotel space. You see very strong NOI growth there, especially in the luxury segment. So that's quite an interesting trend. and also resonates with inflationary times. So in times of inflation, short dated cash flows are better than long-term fixed cash flows, and that's what hotels are for. But not all hotels are working. Actually, some of the hotel market, which has been more dependent on corporate travel, is still struggling. Also, some locations like Germany haven't caught up as much as other locations.
Yeah, I think that we're seeing a change in luxury consumptions, and I don't think the market has yet to realize the impact. So we've seen very recently a very strong correction in the stock price of Hermès, which for me is the benchmark for the luxury sector. And for me, it's also another sign of the credit cycle turning, because luxury is part of discretionary spending. And as such, when we're starting to see like a big pressure on luxury brands such as Hermès, LVMH, you've seen as well some consolidation in the sector happening right now in the luxury sector, and as well some credit pressure coming from names such as Gucci and some other brands, and Ferrari stock price as well coming under pressure. So for me, it is still the ongoing turn in the credit cycle. This is why you need to play more defensive. This is why you see rising dispersions in both equities and credit. And this is why active management matters, because you can't afford to be simply into plain ETF or passive fund. You need to be much more selective in the selection of the issuers or in the equity story.
Absolutely. Before we wrap up, one last question. What we have seen in Japan is quite interesting. So I just wrote the headline is that Japan and German bonds playing catch me if you can. So the yield in Japan, it's really, when I was tracking it over the last months, I saw a jump of 61 basis point actually in the 10-year yield. So which worries me on the real estate side, because everybody is still bullish. The APAC investment managers are still bullish on Japanese real estate because they see now a lot of rental growth there. I saw that game already before with cap rates, then adjusting hires. But still, if I open that up, not just from real estate, but more from the broader macro side, you look a lot also at yen and the weakness in yen.
Yes.
How is this all connected?
There's only two options on the table for Japan. Either they let the bond market crash, or they let the currency crash. They don't have that room. They don't have this. They don't have this luxury. Simply because if you were talking about real estate, for example, now you have like 10% of Japanese homes which are empty, because the size of the population of Japan is contracting. At the same time, they have this huge pressure coming from rising wages, inflationary pressure building up. So the Bank of Japan is really in a very tight spot. They can't let rates rise too fast. They can't let the currency collapse too fast. So I think the only option is some kind of controlled demolition, and that will go. I think they will prefer to sacrifice the currency rather than their bond market. You also have to take into account the pressure coming from repatriation risk. Japan is the largest creditor in the world. They own very, very substantial size of US markets. If I just take the credit market, there was a study which was done many years ago from UBS, I remember, and I was a bit shocked by the size of the Japanese print on US credit markets. They represent at least 12% of US credit markets, which is a considerable amount when you think about it. So Japan is a very big creditor of the world through their pension funds, through the GPIF, as you know, as well through the life insurance companies. And there will come a point probably that Japan will have to liquidate overseas fund and repatriate some funds. So we'll see how it plays out. But the big story has been, of course, the weakening of the carry trade. And it's quite interesting to see the opposite trajectories of Chinese yields versus Japanese yields. And if you take the 10-year China, 10-year China has broken the 2% level and now is trading at 185%. And Japanese yield 10-year now is trading way above 2%. So it's like Japan is it was called the country of the rising sun, but the sun seems to be setting in Japan, whereas China is still rising. And in terms of I would say de-dollarization, part of the de-dollarization process comes from the internationalization of the yuan. So we see this through a larger rise in terms of bond issuance in Chinese yuan, the famous dim sum bond market. So as such, the yuan is becoming a little bit more international, and it's taking a rising portion of international markets per se.
And that's very interesting because as I have seen it, many Western institution investors have been trying to exit the Chinese market, also strategically, also probably also due political reasons. What's happened in the wake of the Ukraine war. So it's quite interesting to see such a trend. Also, and I think one needs to closely follow that also.
Absolutely, and in terms of the slowly but surely turning Chinese economy from production to large consumptions, as well as providing more health support, I would say, for an aging population, which is also a big factor for China, which is a big headwind for the Chinese economy. As such, you need an international bond market to support your life insurance policies, to support your insurance and your health sector. So it makes sense for Chinese to seek overseas financing for their own consumption market, because capital account being closed for Chinese, it's very hard to take for Chinese to take their money out of the country. But in a similar fashion, I think that yuan needs to get financial support from diversification if they want to trade in more actively in energy markets in yuan, for example.
Thank you. I think that's a good closing remark now on the Chinese side and not on the US side. And thank you, Martin. Again, we have covered so many topics, and we will come back again in 2 weeks from now.
Thank you, Zoltan, and looking forward to another conversation.